Hey, good to have you here again. I have yet another time of day study for you guys. And this is especially for those of you who are interested in trading gold when it's trending higher. So if you are bullish on gold, then you want to know what time of day the market is most likely to create the daily low. Whether you are looking to establish an intraday position or a swing trade position, this is highly valuable and relevant information because this helps you to align your trading with the institutional money flowing into the market. First of all, please do remember that we don't provide any investment advice and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Here's a quick breakdown on what we're going to cover in this video. First of all, for those that are new to trading and maybe haven't traded gold before, I'm going to give you a very brief introduction on gold market, and then we take a look at the research questions, the motivation for the research, so that you understand why we do this research and how it can benefit you as you try to build a better trading edge for yourself in the gold market. And then the very exciting results from this study. And if you hang on till the end, I'm going to give you 2 trading strategies that are likely to benefit from this kind of research, and I'm going to explain you why. So let's take a look. So here's a quick introduction on the gold market, just in case you are new to trading and gold market. So basically you can trade it 24 hours a day from Sunday 11 p.m. to Friday 9 p.m. GMT. And you can trade gold in 3 sessions. There's the Asian, European and US sessions. And if you want to see or take a screenshot of these session hours, now feel free to do it now, because I really want to move on and get into the fascinating and revealing results from this statistical study. We have established in the previous videos in this series that it's the European and American sessions that are the most volatile, the most business is done there. This is where the big multinational corporations transact currencies to facilitate international business transactions, etc. But this is also the time when the banks trade a lot of money from behalf of their clients. And then you have the hedge funds, investment funds, and everybody else trading during these hours. So most of the world is trading during the European and US sessions. That's why we want to concentrate on those hours in this study also. So in this study we seek to answer the following research questions. What time of day the long trades in gold have A, the best probability of success, B, the best reward to risk ratio, and C, how large are the average moves from the daily lows established at various hours during the trading day. And I'm going to give you a couple of examples here so that you understand how this is relevant and why and when. So when you have the market moving lower in a trend, it really doesn't make sense to ask where the daily lows are, because the market is more likely to move below the daily lows sooner or later. But when the market is moving higher, then knowing the potential local low or statistical probability for the market creating a daily low, say at 1 p.m. for instance, that is valuable information, and that's what we're trying to establish here, so that when you plan your trading strategies or you use those strategies that I'm going to provide you here in the end of this video, then you have sort of higher confidence in your trades. And you know that statistically this is a good time to be looking for long trades in this market. In the part 1 of this series, we established that there's a huge difference in volatility between the Asian session and the other 2 sessions. So like you can see from these numbers here, it's a huge difference. So that is why we concentrate on the European and American session in this study. So first of all, we want to focus on the uptrending periods, and then the second sort of stipulation here is that we want to use London and New York session data only. And just in case you wonder, how do we define uptrending periods? It's very simply the 1 hour SMA, the SMA 150 in the 1 hour chart pointing higher. So this is a very simple definition of an uptrend, but it's a robust definition, and that's what we chose for this one. Therefore, in this study we filter out all the data that relates to periods when the market is bearish, and we filter out all the periods when there is not likely to be high volatility. So in this gold time of day study, the study period is from January 2020 to September 23. With the full data set, the number of observations is 21,651, and I'm using the 1 hour time frame. And in the filtered data set, this is where we have filtered out all the periods when the market is not trending higher and where the volatility is likely to be low, i.e. the Asian sessions. Then the number of observations is 6,532. Okay, next we can take a look at the exciting study results. So we are looking at the number of occurrences of daily lows per timestamp. And here I have the first chart with the results. First of all, note that the timestamps on the x-axis at the bottom, they are in UTC +3. So you can easily convert this to your own time frame or time zone rather. And then you can, if you struggle to remember what time this is, you might remember, especially if you've been trading gold, that London opens at 10 a.m. in UTC +3. So this is from London open to New York close. So on the y-axis we have the frequencies, and here these labels represent the number of times the market has created the daily low during these timestamps. And very quickly you can see that there is two very distinct groups. There's the European session with most of the daily lows created during the uptrends in the European session, and not that much in the US session. And I also wanted to see these numbers, 77, 59, 76, 106 and so forth. I wanted to see percentages for these numbers. Here they are. So 10.9%, 8.4%, 10.8%, 15%. These might not look like big numbers to you, but when you combine these together, you have a very clear picture. Like here, we have 10 a.m. to 2 p.m. Most of the lows are formed there, 57.7% of the time. That's significantly more than during the rest of the day. So this picture helps you to decide when you should be looking to be a buyer in gold market if the market is trending higher. Let's take a look at this picture again. So here I have two colors that highlight the differences. So if you try to be a buyer at the daily lows during the US session, there are situations where the market almost 100% of the time doesn't create the daily low at that hour. And during the other times, the failure rates would be pretty good, pretty high as well. I also wanted to see the average 5-hour move from these daily lows, and here is the chart for you. Here we go. So on the y-axis we have dollars, and then on x-axis we have again the timestamps. So there isn't a huge difference between these times of day, between the European session and US session. But if we combine this information, we can see that there is a slight tendency to create more movement within 5 hours. And that's obviously helpful if you want to create a intraday trading strategy for gold. So there's slight tendency for the market to move more during the first hours of the day, starting from the London Open. But if you combine this information with this chart here, you know that you have better chances of creating a profitable gold trading strategy using the first few hours of the day for your buy operations when the market is trending higher, because there's also a higher likelihood for the market to move more during these hours. Although the difference isn't massive, it is still significant. And then I wanted to see what might be the result if I hold the trades for 24 hours instead of just 5. So now the picture is very different. Actually, you wouldn't make that much money, or obviously there's lots of factors that come into this, but the potential for holding the trades for 24 hours relative to holding them for 5 hours or so is quite big. So here we have even negative or break-even results for holding the trades for 24 hours. Even though we have a couple of occasions where there's massive $23, $24 or $25 moves, you have to remember that also at the same time there's a low probability that the market creates a low during those times. So it means that if you try to buy close to these time stamps, expecting to get the big moves like this, it's counterproductive, because you are going to most of the time have the market to whipsaw so much that it might actually stop you out before it moves at all. The trading strategy number 1 is known as Bollinger Band crossover strategy. And with this strategy, we want to be buyers only when the SMA 150 in 1 hour chart is pointing higher. Then we look for times when the price moves below the lower Bollinger Band, and then the low value of the price candle crosses above the lower Bollinger Band. So here we have one example where the market is already bullish as per the moving average filter. The 150 period moving average is pointing higher, and the market moves below the lower Bollinger Band. Then it moves back inside. So you could either be a buyer at the close of this candle, or alternatively, if you want more confirmation, you want to see 1 hourly candle closing inside the Bollinger Band or above the lower Bollinger Band. So depending on your preference, the buy signal would be somewhere here. Now, obviously you have to, when you build a trading strategy, you need to think through how much risk you can take per trade. Obviously, then with that figure in mind, you can start thinking how far the stops should be placed and how big position size you can employ. Let's take a look at the potential here in this trading signal. So obviously this is just one, and there'll be thousands of trades in when you run the strategy, but this is just one example. So the first leg in this up move was about $16.3, and those that stayed with this uptrend that benefited even more with the second move or the second leg higher, resulting in a move that's over $41. Then the next signal using this method comes 2-3 days later in the week, and here's the London Open on Thursday, the 13th of July, and quite soon after that the market moves below the lower Bollinger Band and then closes above it. So there's the buy signal. This time the move is much smaller, but obviously that's part and parcel of the package when you're trading. You never know how much the market might move. This was $5.2, so not a bad move either if you can catch that. And next we have a couple of signals. One of them not so good, probably a signal that would have resulted in a break-even trade or a stopped out trade. The market moved only $3 from this low, the candle low that gave the signal. But then later on we have a signal here again during the European session soon after the London Open, and the market moved, let's see, I think this move was quite sizable, from the candle close there to about roughly $30. So that's a decent move higher. Next, I want to talk to you about a breakout trading strategy using this research that we have just completed. So based on the research, this time of day in the European market here, like in this example picture here, the market has upward bias. The 150 period moving average is pointing higher and the daily low is already established. So when the market starts to rally and it has created the daily low, you have much more sort of mental capacity to hold to the trade when you take the trade. And when do you take the trade? The answer is here. We have a market structure level that is penetrated, and when the market retraces to the level and then reacts higher again, that's the point where we have further confirmation that the bulls are indeed in charge of this market. So there's the first example. Let's take a look at the second one. Again, the same process. As per 150 period moving average in the hourly chart, the market has upward bias. We're looking at the 15-minute time frame chart here. The daily low has been already established in the European session, and now we have two occasions here where the market moves above a market structure level, comes back to it and reacts higher. There's our signal to look for a long trade or consider a long trade. Then the market rallies beyond the next resistance level or market structure level, retraces back and bounces higher. And that's once again our confirmation that the bulls are indeed still in charge of this market. And here the example number 3. Again, market has upward bias as we have studied here, and the daily low is established already. This is a little bit later, this is in the US session, but still the same idea applies. The market rallies beyond a resistance level, comes back to it, rallies, and then comes back to it again, but then starts to rally once more. This was really good stuff, wasn't it? I hope you found the video helpful and informative. And if you liked the video, please give us thumbs up, and I look forward to seeing you soon on the next video. Take care, trade safe.